Welcome everybody to join this panel. My name is Jun. I'm the moderator. So first, I suggest we make introduction of ourselves, starting from myself. So as I said, I'm the general manager and head of investments, China at Schroder Adveq. Schroder's group is one of the largest independent asset managers in Europe with more than 200 years history. Schroder Adveq is the PE division within the group. We have more than 20 colleagues team here in China mainland, and we currently have both US dollar and RMB funds under management. Thank you, Guan. So I pass on to Manjia.
Thank you, Jun. My name is Manjia Guan. I'm with Capital Dynamics to cover private equity fund investment at Capital Dynamics. Capital Dynamics is a global asset management company with $17 billion of asset under management. We have three main business lines, which is private equity, private credit, and clean energy infrastructure. Private equity is actually the largest part of business. We have started investing in the region since 2007 when we set up our first office here. Over the years, we have been active investing in this region. We have invested in some 50 to 60 funds across the region. We have also developed from a pure primary fund investor at the very beginning to where we are today, being able to offer comprehensive solution to our clients and to our GPs by investing in private equity funds, working on secondary deals, help GP to structure their access and partner with them on co-investment opportunity. So that's us. Very happy to be here with everyone here online.
Thank you, Manjia. So now I pass to Pamela.
Thanks, Jun. Hi, everyone. This is Pamela Fung. I'm a portfolio manager with Morgan Stanley Alternative Investment Partners, which is the private equity fund of funds group within Morgan Stanley. And our group covers the spectrum of private market solutions, from buyout to private credit to venture to special sits, across fund investing, co-investing, and secondaries. And how we would like to differentiate ourselves is we have a dedicated focus to more inefficient parts of the market where there's less capital, which may be overlooked. And within that, finding unique managers who can outperform. And as part of that, we focus quite a bit on first-time funds. So the topic for the panel today is quite appropriate for us. I myself focus specifically on Asia Pacific, where we've backed a lot of first-time managers and which have been able to deliver very strong performance. So I think today's topic should be quite interesting for everyone.
Thanks, Pamela. So before we jump into the detailed questions, let me explain the Asia Pacific PE universe to those who are not overly familiar with the market. So I use China market as an example. So because China takes the lion's share of the Asia Pacific PE market. So basically from 2017 to 2019, total PE capital raised globally is around $600 billion, in which 1/3 is raised in China. That number includes both the US dollar and RMB. When we look at the number of the GPs, there are around 600 US dollar GPs in China, but there's also another 12,000 RMB GPs in China, which I hope with both numbers, hopefully give audience an idea about the market in Asia and also in China. So for this panel, we need to answer two simple but important questions. Question one, whether to invest into Asia Pacific from international LP's perspective, which includes current portfolio construction policies and looking forward, whether there are any changes due to pandemic or US-China tension. So I would like to pass this question to Manjia first.
Thank you, Jun, for the question. Simple answer to your first question is yes. We have seen Asia as a very important part of our portfolio. We actually look at Asian market from several different dimensions. Firstly, from portfolio construction point of view, when we look at the upper quartile private equity fund performance across region over the last 15 years, region by region, US, Europe, and Asia, No one single region has been able to outperform the others for more than 5 consecutive years. So for global investor like us, actually it's very important to construct a globally diversified portfolio to achieve the best blended long-term return. And obviously, Asia will be a very important part of that. And second point, actually is more important. Asia has presented us with some very compelling investment opportunity. So if we look at the market, we have seen Asia has moved from pure global manufacturing base at the very beginning to become a global consumer market and playing a more active role in technology innovation and business innovation these days. So over the course, we have seen a lot of very exciting new investment opportunity coming out. And some of them actually would be able to scaling up at speed, even much faster than what we can see in a business elsewhere, or we can find even in the double-digit growth golden era in China. And lastly, things Jun talk about the US-China tension. Actually, under this climate, Asia could have a different meaning for us. Because when we look back to the past 3 years, Asia economy actually turned out to be more resilient than many of us initially expected. So that ability to withstand market shock provide a safety cushion. And if the global market is going to be more disconnected, then for us, our portfolio in US and Asia or China probably will look less correlated. And there's a need for us to build a direct access to this market. So for us, Asia has become a major investment destination along US and Europe. For any of our current global product offering, Asia represents a percentage just slightly smaller than US and Europe. That is a pretty big change compared to the very low base when we first started our business here back in 2006. And to the other question about our investment strategy in Asia, I think I want to echo what Jun has just elaborated about the Asia GP universe. I think one very unique feature of this market is that it's very dynamic. We have seen this market becoming have a more complete ecosystem. There are more depths, but at the same time, we are seeing greater dispersion among fund manager performance depending on their sector, their strategy, and team experience. And that requires us to keep refining our investment strategy in this region. For example, when we look back to the funds that we invested before, some of the brand name fund managers deliver great return for us, but not often keep delivering these days. So we need to review all our existing fund manager relationship at least on a yearly basis. And on top of that, we have been putting greater emphasis on emerging manager who can differentiate themselves in the market. They could be a sector specialist, a spin-out leader, or a value-adding partner to the entrepreneur. So when we look back to our investment history over the last 2 years, we actually have investing in 9 emerging managers, including 3 first-time funds. So I think that the number will be able to tell quite well about our strategy.
Thanks, Manjia. It's glad to see that international LP like Capital Dynamics are still very positive about this market and also looking forward. So, Pamela, if you have anything to add.
Yes, so I thought Manjia's comments were very relevant. I think from a diversification perspective, as well as a performance and underlying economic perspective, Asia is a very important component of global private equity. And within that, I think one comment to make is that the Asian private equity markets are still developing and evolving. So what you see on the ground is there's, well, I would say in the last decade to 2 decades, you've seen a lot of managers opportunistically investing in the market, private valuations being lower than public valuations, and the opportunity to take companies public and benefit from that multiple arbitrage. But I think what we're all seeing on the ground and very excited about is in the last 5 years, you started seeing managers evolve. There's a lot of first-time funds emerging. There's a lot of groups where they were of the generalist mindset before, but they're seeing a specific market opportunity and spinning out in order to tap into that opportunity. So I think we're just starting to see that emerge in Asia. And that's what's the exciting thing about what's going on the ground. So being able to back new and innovative managers is what keeps things interesting and what can lead to potential outperformance in this region.
Thanks, Pamela. You partly also touched the second question. So I don't know whether the other panelist Dorothy is able to make several comments. Maybe not. So then we can go straight to the second question. So once we decided to invest into Asia Pacific, then the natural question is how to select managers in Asia Pacific from international LPs' point of view, and the attitude towards the new managers, especially important is actually looking forward, whether there are any changes, and what are your selection criteria, and for those existing managers, what's the re-up criteria? So Pamela, talk a little bit about that part. So I would like to give that question back to you to further elaborate it.
Okay. Yeah, we can go into a lot more detail, and this is what the three of us do day in and day out. So there's a lot of learnings here. But in backing a first-time manager, you need to understand their motivation, as well as the market opportunity that they're looking to attract. In terms of motivation, I think statistically it's been proven that first-time funds, first-time emerging managers who are spinning out or setting up their new fund have been shown to outperform. And a lot of times that's because they have very strong conviction about a particular market opportunity. And they're also taking a risk as well. They're leaving the safe haven of their prior firms. They're usually investing a lot of capital in this new opportunity. There's also a huge opportunity cost associated with setting up your own fund. And as a result, a lot of these groups do outperform. Although I would caution that there's a lot of shades of gray in terms of managers deciding to set up their new funds. So what we see is some groups, they're opportunistically just trying to set up a group where they're able to attract the kind of premium economics that the private equity asset class commands. There's also other groups where they were forced to leave their prior firm. So reference calling and really understanding the GP's motivation is pretty key in assessing a new first-time fund. I would also point to sometimes there's a market opportunity that the GP thinks is very attractive, which maybe hasn't been proven out before. So we've seen that a lot of times in different market segments that we've backed. So for example, healthcare funds, when we first started seeing the first crop of healthcare funds 5 to 8 years ago, that you could see the policy tailwinds, but at the same time, you didn't know if it was a viable investment opportunity. Similarly with other market segments, for example, pointing to Southeast Asia, small mid-cap, India, buyouts, a lot of that, the investor, the LP has to take a leap of faith in terms of understanding, is there a viable market opportunity? Is there sufficiently deep deal flow in order to address this market opportunity? And can the GP execute within this opportunity? Because a lot of times we see the spin-outs, it's from a large cap fund going to maybe a smaller cap segment of the market. And you have to take a leap of faith in terms of whether that opportunity is there. I would also point to team dynamics as another thing to consider. So sometimes you'll have 1 or 2 partners spinning out together, but they need to rebuild a team. Are they able to institutionalize that process and repeat the success that they've had in the past? And the last factor is track record. So really understanding what have they done in the past? Does that point to the fact that they'll be able to deliver that in the future? And is there a consistency about the way they're able to deliver their returns? So while historically some may have a very good track record, it may be dependent on 1 or 2 deals. It might have been a function of luck. So you really need to dig deep and really understand how that track record came about and whether it's repeatable. So it's not a straight answer. You have to consider a lot of different factors. But if you're able to pinpoint the intersection of what makes a GP successful, it is possible to be investing in funds that can very much outperform the rest of the market.
Yeah, what about these existing managers?
Sorry, I did forget to address that question. Existing managers. So as Manjia was saying, and Manjia, I think you'll have a lot of comments here as well. But you do need to make an active decision whether to re-up with a manager or not. What we tend to see with managers in Asia is once they've been successful, the next fund is significantly larger than the previous fund. And what that means is they're tapping into a different market opportunity altogether. Which may not be bad. I have definitely seen managers that continue to perform even at the larger sizes, but you need to be aware that they're addressing a different market opportunity. And that market opportunity may be more competitive, it may be different. Their team may not be sufficiently large to tap into that opportunity. So again, the re-up decision needs to be, I think this is true in every geography, but especially so in Asia where the fund sizes jump up pretty significantly. Each fund commitment needs to be assessed on its own merits. And you can't just say, it's done well for us in the past, we're going to re-up. Each decision is essentially a new decision.
Thanks. So Manjia, any comments from your side?
Yeah, probably to add to our new manager selection criteria, agree with Pamela said, actually there's a lot of unique factors that we need to consider. Maybe also to add on to the alignment interest topic, because generally I think most of the new funds as come out with a better alignment interest with LP. However, in some cases, we see that sense of hunger only apply to the founder, not necessarily to the rest of the team. If the rest of the team just see themselves as salaryman hired by the founder of the new platform. So actually we want to see a strong team alignment interest and a fair incentive schedule to make sure that there's a team with common interests rather than just one individual tied to the new fund. And also relating to track record, which is a very important part of a due diligence. Many of the founders actually spin out from another platform will generate a track record from parents company or from multiple platforms. But it's a very important part of the work to verify the track record and see how much % of this track record is rely on their own network, their own active involvement in the running of the investments. How much % is actually more rely on the parents company's network and brand name in the market. So oftentimes this actually take a lot of time, and it's very important for us to take active reference call to their prior company, to their colleagues, partners, and also very importantly, to the other co-investor and portfolio company management to understand the new team's key members' commitment into the prior commitment to the prior investment. So that's a very important part. And talking about re-upping manager, although I am a strong believer that we should put more emphasis on emerging managers, just as I mentioned that we have invested in quite many over the past few years. But I also don't think re-upping with the existing one would be bad in all the cases, because ultimately all the managers today, including the new manager today, they want to have a long-lasting GP LP relation. And for investors like us, actually we want to see how a GP has evolved to capture the new market trend with sustainable skill set. So for new funds, probably they're faster to capture the new market opportunity, but a mature one, they probably will have richer team resource and sometimes with privileged access to some industry fund runner. So it's interesting to see how each of them can leverage the available resource to position themselves in the PE value chain. So at Capital Dynamic, we have backed quite a few of first-time fund. We have most substantial exposure to probably fund 2 to fund 3, but at the same time, we also selectively invest in some best performing fund manager with their fund 6, 7, or 8. So I think one thing in common is that they never stop learning. And if a GP can keep learning and adapt to new market trend and build up the team resource to better fulfill that strategy, then it will be still quite attractive. But as Pamela said, actually in every single case, we don't take the re-up decision very light. We actually redo the entire due diligence just as how we look at new manager. So I think for us, actually, how to judge the investment success is not by investing in a new or old manager. It's by picking the right manager to deliver the best performance for our clients. So we just treat them equal, and we conduct the same level of due diligence, either with a new manager or with a re-up decision.
Thanks, Manjia and Pamela, for the comments. I think it's good that from international LP's point of view, they are still positive about Asia, looking forward as well. And but for both sides, like the LPs also need to do more homework. The GPs also need to keep on learning. So I think that's the conclusion from today's the panel. So having said that, let me pause here and give the audience the opportunity to ask questions. Maybe a question from my side. I would like to ask both Manjia and Pamela. So what did you see the difference when you compare the first manager in Asia with other regions? If you had a discussion with other with your colleagues, and to see anything that Asia first manager can learn from the best practice Western world.
Yeah, maybe I can take that question. We see many of the manager actually, particularly in China, when they raise the first-time fund, actually the GP got experience from a bigger platform, but they do not necessarily have a very good fund management experience. So sometimes we met a manager over the course of a couple of years. We met several times. We like the strategy. We like the team, and it looks like the previous track record looks quite strong. But when we dug deeper into the due diligence process, we find that some of the information is still missing, because the team probably do not keep track of all the entire previous deal investment process with a very clear record. They may not necessarily have a complete set of portfolio company information in hand. That actually makes our due diligence more challenging. I think for Western first-time fund manager, generally they would have a greater emphasis on building up a fund management system from the very beginning. So it actually saves a lot of hassle. So my view is that for new emerging manager, probably is still resource constraint, but I feel that it's still very necessary for them to consider building up an institutionalized framework from the very beginning. It's always easier to do it when the portfolio is small, and then continue to build on that, rather than wait until a later day and revisit everything and trace back. So I think if a GP has a sound process in place, it definitely helps.
Yeah, June, just to add to what Manjia just mentioned, I think the other thing about Asia, this is both a good and a bad thing, is that a lot of times the spin-out GP, they're trying to invest in a new market opportunity that hasn't really existed before. And the challenge in Asia is, one is there's a learning curve for the LPs. So not just those based in Asia, in the US or Europe, but also those based in Asia, because you're trying to invest in something where others have not really invested before. There have been no dedicated funds in the space. So there's an element of educating the LP. There's also another element of getting the data together. And I think data is much harder to come by in Asia as a whole versus in developed markets. So I think that's also a challenge that I would see Asian GPs facing, as opposed to their counterparts in the US, whereas the US is a much more developed market, where a lot of market segments have already existed for a long time, and the GP is addressing an existing market segment, but maybe just in a different way. So I think that's a challenge that GPs on the ground need to appreciate, but not insurmountable.
Thanks. So we see some questions from the audience. So the first question is actually, what would attract you to a GP at the first meeting? So maybe Manjia can start, or
yeah, I think
would you like to pick that question?
Yeah, I think what attracts us to the first-time meeting is that the strategy first. If the GP have a strategy that is very compelling, and the previous track record so that they have relevant experience pursuing this strategy, then it will be quite interesting to meet them and get to know more. Generally, if assuming that we do not know a manager, do not know the particular individual before, then I think that previous track record is very important. If they can show us how they have been able to source some very attractive deals, how they have been able to make influence in the course of company management and influence the exit decision. I think that will actually trigger the interest point, because we definitely will want to know more how they achieve a very strong track record by doing so, and whether there will be opportunity for us to partner into the next funds to capture such opportunities.
Yeah, for me,
Okay.
the first meeting is really to capture my interests, because well, maybe not in the COVID era, but previously, you could be having 3 to 5 meetings with a GP every day. And so it's very important to capture the LP's attention in that first meeting, because we meet so many managers. There's so many people trying to do the same thing that you really need to find a way to stand out. So whether it's excitement about your strategy, or being able to explain the strategy in the market segment in a very simple and compelling way, a good track record, of course, always helps, but you may or may not have that. So you need to do something to stand out and to capture the LP's attention, so that they really want exposure to your strategy and your fund. I think that's the most important thing in the first meeting, because other things can be addressed in subsequent meetings. But if you don't capture that in the first meeting, you're not going to get that second meeting.
Yeah. So a follow-up question is actually, has the DD process changed dramatically? Do you require in-person meetings?
I'll take that one quickly, since we're running out of time. But unfortunately, it's very difficult for in-person meetings these days. Ideally, we would like to have in-person meetings too, because investing in a fund is a very long-term decision. You really need to know the people behind the fund. I think right now we're having to make do with virtual meetings, but it's not insurmountable. So I think Zoom and video calls are a good substitute. And of course, I think all of us have our own local connections where we're able to diligence based on our own personal and professional networks.
Yeah, thanks. Another question is like, when you reallocate to same manager, how do you see their strategy to invest in a portfolio of early funds and leverage preemptive rights?
Yeah, I can take that question. Actually, I think we look at this on a case-by-case basis, because I think sometimes we need to distinguish whether the manager is just relying on old relationship to repeat the same investment across different funds, or whether they really see a real new growth opportunity from making a follow-on investment in a different structure. So I think that's very important to distinguish the motivation behind doing a deal across funds. So if we see there's a real angle to enter, which is different from before, and then generate additional value for the funds, then we won't be against it. But certainly there will be certain conflict interests, and we would prefer the GP to present the rationale behind it clearly to the LP or to the LPAC for a thorough discussion.
Thank you, Manjia. Due to time is running out, so let's start wrapping up. So thanks for the questions from the audience, and thanks for the contribution from the panelists. Thank you.